Assalamualaikum and a very good day to our beloved lecturer, Prof. Madya Dr. Siti Zabedah. Today, our group will present the group project. The topic that we have choose is different disclosure of risk management in annual report of Malaysian federal statutory bodies. So here are our group members. So we start our discussion on the first part of this group project, which is introduction. So basically there are two purposes of this study, and the first one is to examine whether the federal statutory bodies FSB in Malaysia has disclosed the risk management on their annual report for the year 2016, 2017 and 2018 by concentrate on the financial and non-financial reporting section. The second purpose is to perform the content analysis on the presence and types of the risk being reported by the non-financial segment along with the scope of such reporting. Next, we have to know the concept of the risk management. So what is the risk management? Risk management is a process of identify and analyze potential risks of threat and taking precautionary measure on the organization capital and earning. Assessing risk management permits the organization to prepare for any unexpected risk rise from the FSB activities. So at the same time, minimizing the risk before they actually happen. The risk management disclosure objective is to disclose the nature of threat from the financial instrument to which the FSB is exposed to and how the FSB has been managing their risks. So to further the study of this project, we have choose 5 Malaysian federal statutory bodies. The first one is MYCC, Malaysian Competition Commission, MMC, Malaysian Medical Council, MQA, Malaysian Qualification Agency, ASM, Academy of Science Malaysia, SPAN, Suruhanjaya Perkhidmatan Air Negara.
Assalamualaikum warahmatullahi taala wabarakatuh. My name is Alifa Iliana binti Jamaluddin and my matric number is 261099. So now I will further discuss about the literature review and our analysis about different disclosure of risk management in annual report of the Malaysian federal statutory bodies. So for further discussion, federal statutory body shall be governed by the law and it is directly from government, and its function must be in line with the government objective to carry out certain duties and responsibilities in line, like what I previously said, in line with the objective of their government, and they act as a public regulators that perform all the government's regulatory and enforcement function. So through this paper, I will further explain about risk management disclosure in the annual report of federal statutory bodies in Malaysia. And for instance, in our paper, we have chosen 5 federal statutory bodies, which are first, Malaysian Competition Commission, MyCC, second, Suruhanjaya Perkhidmatan Air Negara, SPAN, third, Malaysian Medical Council, MMC, fourth, Academy of Sciences Malaysia, ASM, and last, Malaysian Qualification Agency, MQA. So as a brief introduction, we want to emphasize that risk management strategies and economic performance are key components of management competence and decision making, because it shows how important risk management disclosures are in the annual report itself, because we can see in an early stage of annual report development, lack of risk management information in annual report has guided all the regulators as well as researchers like Rosley to ask for risk management information being provided in the annual report, because it can be concluded that actually risk management has become an essential component in corporate communication, because where many firms are eager to provide more disclosures on their risk management. There are plenty of reasons on why risk management disclosure is important for firms, companies, as well as public organizations. So, why risk management is needed? It is because first, compliance with disclosure requirements. Second, to react to the external needs like investors. And third, addressing accountability and stewardship with the parties involved. And last, it is function as a social responsibility. So, the objective of our paper is to study how and where federal statutory bodies in Malaysia disclose their risk management in the annual report. And from our information, there is no recent research about risk management disclosures in the context of federal statutory bodies in Malaysia. But however, studies on risk management disclosures in corporate had been done by Azlan Maran in his research title, An Exploratory Study in Risk Management Disclosure in Malaysia Annual Report. His his main purpose of his studies is to provide clear explanation about the risks that being disclosed in annual report. And from our information also, several studies have been conducted in Western countries in which those organizations have disclosed their risk management. Stated by Azal Maran itself, in 1997 in the USA, their financial institution published the Financial Reporting Release Number 48, where it's required all the SEC registered member to disclose both their qualitative and quantitative information on market risk to firms, especially in the notes to the account and also in the management, discussion and analysis, or so-called as MDA section. And also a similar regulation has been applied in Canada, where the exchange also requires the firms to report their risk management disclosure in the information in the MDA section. And Azal Maran, using the content analysis that uh, he aims to discover the quality of risk management disclosure in the annual report of Malaysian firm. And also he focused more on the non-financial section of the report. And his aim of his paper is to carry out all the information that relate to the non-financial section on the presence and level of risk that the annual report being disclosed, so as well as on the level of such reporting. And this is similar to our objective of our paper, where we want to focus on how and where federal statutory bodies in Malaysia disclose their risk management in the annual report. As we know, public organizations have crucial commitment in delivering effectiveness and efficiencies, because they must deliver a quality that less expensive and mitigate the fraud and poor value for money decision making. The community itself deserves that the government will regularly recognize the risk and develop strategies to mitigate the effect, and therefore the government should look for a way to enforce risk management in order to increase the efficiency of public sector revenue management. And the application of risk management is typically necessary because it is must in order to achieve organizational objective by mitigate the negative effect before it's happened. And according to Zadi, 2016 stated that most of researchers have suggested that organizations are unable to assess their risk in annual reports, and also to include relevant risk policy measure statement and measures to minimize the risk. Risk disclosure studies have concentrated on voluntary disclosure of internal controls in annual reports, compulsory and voluntary disclosure of risks in annual reports, and mandated and voluntary disclosure of risks in interim reports. So risk disclosure, it seems to have the effect of lowering the volatility of investors and the variety of viewpoints on organization stock valuation. It's also found that financial risk was the highest regular risk disclosure and included details related to foreign currency operation. The most commonly listed are risk management instruments using forward offers, future futures and swap contracts in the form of hedging, credit risk, which is followed by the market risk, deals with the company's reaction to competitiveness, is falling behind financial risk, and disclosure of nature are often qualitative and prevent details and range. So the factors that influencing the disclosure of risk management is compared to smaller ones. Larger businesses report more risk details since the number of stakeholders often increase as the business expands. So in order to respond to the needs of larger stakeholders, the organization is also expected to reveal more risk information, and reporting by the organization through annual account and reports is a way to disclose their business operation, including risk management performance. And the relationship between risk disclosure, the presence of risk management committee, and the number of risk committee is highly important. In the literature, the disclosure of narrative risk management of companies had gained awareness because they know how important the risk management disclosure in the annual report. The key drivers of risk management disclosure efficiency were multiple size, specifically number, scope, extent, and perspective, and found business scale, cross-listing, and firm profitability. Necessity disclosure of risk is generated from the demand of current and prospective investors to gain future knowledge to assist them in making different economic choice. Risk disclosure offers users with information to allow them to evaluate the risk impacting the potential economic success of the business. And also, it has been known that risk management disclosures in the annual report can strengthen the financial reporting integrity and enhance the standard of disclosure by update the investors about the condition of the company to make sure them know the real situation of the company itself.
Good day, I'm Hirosha daughter of Vijayan and my metric number is 264096. Now I'm going to present on the research method for our study. The objective of our study is to assess the current level of risk disclosure of the federal statutory bodies. The analysis unit for this study is the annual report of the selected 5 federal statutory bodies, which are Malaysian Competition Commission (MYCC), Malaysian Qualification Agency (MQA), Suruhanjaya Perkhidmatan Air Negara (SPAN), Academy of Science Malaysia (ASM), and finally Malaysian Medical Council (MMC). Our research used secondary data where all the information is taken from the annual report of the year 2016, 2017 and 2018. The examination of the data for our research is through content analysis. The initial step of our research method is the identification of risk. It means that we need to identify whether the federal statutory body disclosed the risk or not, and if it yes, at which part they disclose in the annual report. And it is followed by the having a list of the risk disclosure and construct a table from the listed risk above. Finally, there is a comparison on the similarity and distinction of the risk among 5 federal statutory bodies based on the table of the listed risk.
After analysis has been made, this is the result of our finding.
Now I will discuss about our finding in analysis of risk management in each federal statutory bodies. So I will start with MyCC, Malaysia Competition Commission. In MyCC, we have retrieved 3 years annual report, which are 2016, 2017, and 2018. There is no disclosure on risk management in 2016, but however, in 2017 and 2018, MyCC had disclosed their risk management disclosures into the notes to account section for both years in note 4, significant accounting policies under 4.11 financial risk management policy. In the annual report of MyCC, the type of risk management that they choose to disclose is the risk management on its financial. The financial risk policy of the Commission aims at ensuring appropriate financial and non-financial resources to carry out its function effectively. The Commission will take into account and manage the risk to financial management as effective as they can. There are 5 quantitative risks that being disclosed in the risk of financial management, which are interest rate risk, credit risk, foreign exchange risk, liquidity risk, and lawsuits risk. So first, I will discuss about interest rate risk. It means that the Commission will know the potential for investment losses resulting from a change in interest rate. For example, the price of a bond or other fixed income investment would fall as the interest rate increase. The change in the price of the bond is known as its duration given the change in interest rate. Second, about the credit risk. In MyCC, the credit risks are known as the possibility of a loss caused by the failure of the borrower to pay back the loan or to satisfy the contractual agreement. Generally, it is defined as the risk that the lender may not earn the principal and interest due, likely to result in the disruption of cash flow and increased collection costs. However, in MyCC itself does not deal with credit transaction materially and is thus not vulnerable to credit risk. Third, about foreign exchange risk. We have recognized that MyCC is disclosing about this risk, and foreign exchange risks are strategies that describes all measures designed by firms or investors to prevent the value of their cash flow, assets or liabilities from unfavorable exchange rate volatility. In spite of that, MyCC does not involve in any transaction that made them involved in foreign exchange. Hence, the Commission is not affected by it. Fourth is about liquidity risk. In addition, the Commission disclosed about this risk as we know that liquidity risk means that an investor or business or financial institution could not fulfill its short-term obligation. The investors may not even be able to convert the assets into cash without losing capital and income given the lack of buyers or an inefficient market. In MyCC, the Commission has practiced a reasonable management of liquidity risk to mitigate any disparities in financial assets and liabilities and to establish an adequate cash and cash equivalent to meet the working requirements of this obligation. And last is lawsuit risk. Lawsuit risk management is defined as the potential that legal action will be taken on the basis of action, inaction, products, service, or other events of an individual or corporation. Corporations usually have some type of lawsuit risk analysis and management to classify critical issues in which there is a significant risk of lawsuits and to take preventive measures to prevent or remove those threats. They vary widely from case to case, and the act that provide MyCC with this type of risk management is subsection 3 in bracket 3 of the Competition Commission Act 2010, Act 713, that stated that although subsection 3 bracket 4 empowers the Commission to enter into contracts, the Commission may be sued under its name if the Commission is in violation of a contract or of any procedure pursuant to Act 712 and Act 713. The Commission may be liable to legal action by third party. That's all from me, and I will pass to the next presenter.
I chose Malaysian Qualification Agency MQA for our study. MQA has disclosed their risk under financial risk management. There are four quantitative risks that have been disclosed under financial risk management, which are credit risk, liquidity and cash flow risk, interest rate risk, and foreign exchange risk. MQA are not exposed to debtor with significant risk. The testing is carried out regularly on daily basis to ensure that the collection is carried out. MQA manage the liquidity risk in order to remain solvent, and they hold the cash and also asset that can be transferred into adequate cash to meet the need for the working capital. MQA are not subject to interest rate risk because they do not carry any debt that involves interest rate in long term. MQA's investment is only involved in fixed saving. Finally, MQA only operates in Malaysia. So the transaction involved foreign exchange is minimal. Therefore, the significant foreign exchange risk it is not exposed to MQA.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Syahada binti Abdul Razak. My matric number is 264371. So for the third federal statutory body chosen for this study is the Malaysian Medical Council MMC. Based on the analysis on the annual report, the group has disclosed the financial and capital risk management under the notes to the financial statement section. Foreign currency exchange risk is the first management of financial risk disclosed by the groups. As most of its trades, assets and liabilities are denominated in Ringgit Malaysia, the risk to the foreign currency exchange faced by the MMC group is limited. The group does manage the risk of foreign currency exchange by maintaining a natural hedge where in an approved bank account, foreign currency denominated cash reserves are held to finance any possible future cash outflows resulting from its activities in foreign countries. In addition to borrowing in the currency of the country in which the investment is based, the group retains a natural hedge by borrowing in currencies corresponding to the future revenue stream generated by the investment. The second management of financial risk is the interest rate risk resulting from the group's borrowing and deposit activities denominated in Ringgit Malaysia. This risk was resolved by the group by using fixed and floating rates, where in their respective notes, the data on maturity dates and effective interest rates are disclosed for financial assets and liabilities. The third financial risk management is the price risk, where the group is exposed to the risk of the equity security price since the investment retained or listed either as available for sale in the consolidated balance sheet or by benefit or loss at fair value. The group's equity investment in other publicly traded companies are included in one of the equity indices of Bursa Malaysia and ASX. The group were not exposed to a risk on commodity price. The next risk management is the credit risk that happens when transactions are made on deferred credit terms. The group looks forward on managing its credit risk by making sure that their clients have a strong monetary position, credit history, and collateral requirements. Liquidity and cash flow risk management has also been disclosed by the group, where it implies maintaining an appropriate level of cash, maintaining the availability of financing via an ample amount of credit facilities committed and the capacity to close market positions. Their aims are to preserve financing stability by keeping dedicated credit lines available and retaining a recognizable amount of deposits to ensure that the terms of their borrowings are complied with. The group is balancing its stable long-term cash flow from its concessionary undertakings to the obligation of its creditor. Finally, under financial risk management, The group has achieved a hedging operation and liquidity risk based on the cash flow hedge for the acquisition of assets. In order to reduce their exposure to the risk of foreign currency exchange in relation to payments to suppliers of assets, the group decided to enter into forward exchange contract where the hedge, which the expected transactions that are denominated in foreign currency are most likely to take place on different dates over the next 12 months. Other than the financial risk management, the group also reported its capital risk management in the financial statement under the same notes. The aim of capital risk management is to guarantee that the group and the company are able to function as a going concern while still maximizing shareholders' returns at the same time. Both the group and the company could alter the number of dividends paid to the shareholders, return capital to shareholders, issue new shares, or sell their assets for debt reduction in order to conserve or alter their capital structures. In addition, MMC actually have a defined way in managing the risk profiles of the group using a system that is specially designed for the risk management called the Q-Radar ERM system so that the risk management activities can be tracked. So this system is actually an online risk management monitoring and database system which enables the group's risk management committee to track risk management activities through an online real-time monitoring and to record the group's risk profiles.
The next FSB is Academy of Science Malaysia, ASM. So after review the annual report of the ASM for the 3 years 2016, 2017 and 2018, we can conclude that ASM has disclosed their risk management, which is a financial risk management. The financial risk management was stated on the notes to the financial statement under notes number 2 in the annual report every year. ASM conduct financial risk management policy because they want to make sure the financial resources are sufficient to perform the operational development while controlling its financial risk. So ASM reported 3 risks, which are credit risk, interest rate risk, and liquidity and cash flow risk. However, the disclosure of the risks are not detailed and there are no particular section discussing their risk management. So the first financial risk that has been disclosed by the ASM in their annual report is a credit risk. So credit risk of ASM come from the debtors. So how the ASM manage their credit risk? From time to time, these accounts are tracked by existing internal process and ASM will take any possible action against outstanding debts from their receivable. The second risk is interest rate risk. So ASM disclosed the interest rate risk in their annual report each year for 2016, 2017 and 2018. The interest rate exists because of the fluctuation of the market interest rate. Hence, the ASM retains fixed cash and fixed deposit to fulfill the requirement of working capital. The last financial risk that has been disclosed in the annual report of the ASM is liquidity and cash flow risk. So how the ASM manage this risk? To retain its liquidity and cash flow, the ASM meticulously monitor its payable and receivable transaction and debt collection from the customers who have reached the maturity date.
The last FSP is Suruhanjaya Perkhidmatan Air Negara SPAN. Okay, after analyzing this FSB, there is a risk management disclosure in SPAN for the year 2016, 2017, and 2018. Okay, the risk management is being disclosed in the notes to the financial statement under notes 2, financial risk management objective and policy. Okay, there are three financial risks disclosed by SPAN, which is credit risk, interest rate risk, and liquidity risk. All of these risks has the same objective and policy for the 3 years. The first risk is liquidity risk. Okay, liquidity risk is a risk linked to the failure to meet its financial commitment and liability when it is due. Okay, SPAN manage its liquidity risk by maintaining sufficient liquid asset level in the form of cash and place it in the financial institution in order to satisfy its requirement and other financial obligation. Okay. Next, interest rate risk. SPN is exposed to interest rate risk related to fixed deposit investment. SPN can be exposed to the loss as a result from the changes of interest rate. Okay, SPN manage this interest rate risk by placing a certain balance based on the maturity terms and interest rate. Okay. The last one is credit risk. Okay, credit risk is a risk of loss as a result from inability or unwillingness of a contractual party to meet its contractual obligation. Okay. SPN is exposed to the risk arising from the activity of hedging, investing, lending, and trading. Okay, the commission practice a policy where the cash equivalents are kept in the bank and licensed financial institution. Okay, credit risk is being controlled by SPAM by application on credit assessment, authorization, limit, and control procedure. The result of finding for the overall different for the 5 FSB. Okay, in the box here, we can see 5 different FSB and different types of risk that can be found in the 5 FSB, whether it is similar for the 5 FSB or there is a few number of differences type of risk for the 5 FSB. As a result from the analysis, all 5 chosen FSB have disclosed 3 similar or same financial risks, which are credit risk, interest rate risk, and liquidity and cash flow risk. Okay, the first one is credit risk. Okay, credit risk information disclosed by the 5 FSB is quite different for each FSB. Okay, the first thing I'm going to discuss is exposure of credit risk. Okay, MYCC are not exposed to credit risk because MYCC are not materially deal with the credit transaction. Okay, MQA, MMC, ASM, and SPAN are exposed to credit risk, but the exposure of credit risk is different for each FSB. Okay, the first one is MQA. MQA is exposed to the risk of lender defaulting, but they are not exposed to significant risk of debtors. Okay, the next one is MMC. Okay, MMC is exposed to the risk of transaction made on deferred credit terms. Okay, the next one is ASM. ASM is exposed to the risk of the debtors. Okay, the last one is SPAN. SPAN is exposed to the risk arises from activities of hedging, investing, lending, and trading. The next thing I'm going to discuss is how the FSB manage the credit risk. Okay, for the first FSB, MYCC, they did not disclose any information on how they manage the risk. Okay, the next FSB is MQA. MQA carry out a credit strategy on the client's financial situation and testing the debtors on a daily basis. Okay, the next FSB is MMC. MMC making sure their client have strong monetary position, credit history, and collateral requirement. Okay, the next one is ASM. ASM manage their credit risk by tracking the receivable account and take action against outstanding debt from receivable. Okay, the last FSB is SPAN. SPAN control the credit risk by application on the credit assessment authorization, limit, and control procedure. Okay, as we can see here, how the FSB manage the credit risk is quite different for each FSB. Okay, the second one is interest rate risk. Okay, interest rate risk information disclosed by the 5 FSB. Okay, the first thing we're going to discuss is exposure. MYCC, ASM, and SPAN have a similar exposure of interest rate risk where they are exposed to risk that comes from changes in the market interest rate. Additional information, SPAN interest rate risk is regarding the fixed deposit investment. Okay, the next FSB is MQA. MQA is exposed to the risk resulting from the unstable interest rate for bond holder which is exposed to the market price. Okay, the next one is MMC. MMC is exposed to the risk from borrowing and deposit activity. Okay, the next thing I'm going to discuss is how the FSB manage the interest rate risk. Okay, for MYCC and MQA, they did not disclose on any information on how they manage the interest rate risk. For MQA, they did not disclose any information because they do not have any debt that have interest rate in the long term. Okay, the next FSB is MMC. MMC manage their interest rate risk by resolving using fixed and floating rates on the maturity date and effective interest rate reported to the financial asset and liability. Okay, the next FSB is ASM. ASM manage their interest rate risk by retaining their fixed cash and deposit to fulfill on the requirement of the working capital. Okay, the last one is SPAN. Okay, SPAN manage their interest rate risk by placing a certain balance based on the different maturity terms and interest rate. As we can see here, the how FSB manage their risk is quite different for each FSB. The third and last risk is a liquidity and cash flow risk. Liquidity and cash flow risk information disclosed by the 5 FSB. Okay, the first thing I'm going to discuss is exposure of liquidity and cash flow risk. Okay, all of the FSB is exposed to the liquidity and cash flow risk. The first FSB is SPAN. SPAN just mentioned that the risk is a link to the failure to meet its financial commitment and liability when it is due. Okay. Next, ASM and MMC has not stated or explained the risk that this FSB is exposed to. Okay, the next FSB is MQA. MQA is exposed to short-term cash flow and long-term funding risk. Okay, and MYCC is exposed to the risk that the asset of investor may not be able to convert to cash. The next thing I'm going to discuss is how the FSB manage the liquidity and cash flow risk. From the analysis, MMC, MQA, and SPAN disclose similar or same style how they manage the liquidity and cash flow risk. Okay, they manage by holding their cash and asset that can be transformed into cash and maintain sufficient level of cash and availability of financing. Okay, for MYCC and ASM, they manage the liquidity and cash flow risk quite different from the MMC, MQA, and SPN. Okay, for MYCC, they use provident management to reduce any disparity in the financial asset and liability. For ASM, they monitor the payable and receivable transaction and debt collection from the customer. 3 out of 5 FSB have disclosed foreign currency exchange risks, which are MMC, MQA, and MYCC. Okay, the first thing we are going to discuss is about the exposure of foreign currency exchange risk. Okay, the foreign currency exchange risk exposure disclosed by the 3 FSB is quite different for each FSB. Okay, for MYCC, they are not affected by the foreign exchange risk because the transaction of the MYCC does not involve any foreign exchange. Okay, for MMC and MQA, they are exposed to the risk of foreign currency exchange, but not significant and very limited because for MQA, their operation are in Malaysia and the transaction related to foreign exchange are very minimal. Whereas for MMC, most of the trade, asset, and liability are denominated in RM. Okay, the next thing I'm going to discuss is about how the FSB manage foreign currency exchange risk. Okay, after finishing doing the analysis, only MMC disclose how they manage the foreign currency exchange risk. Okay, they manage by maintaining natural hedge, where in a proof bank account, foreign currency denominated cash reserve are held. Lastly, MMC and MYCC has additional management risk disclosure which are different from other FSB. Okay, for MMC, the management risk disclosed by MMC is price risk, hedging operation, and liquidity and capital risk. Okay, why do they disclose more management risk compared to other FSB? This is because of their nature of its activity, which is actively trading in the foreign market, where they can be exposed to various risks. Okay, this is also the same case for MYCC. Okay, MYCC disclose lawsuit risk because of their nature of activity, such as they are responsible of safeguarding the competitive process, where they can sometimes be liable to the third party legal action. So they have to add additional management risk disclosure, which can be seen different from other FSB.
Lastly, for the conclusion, we will recap about the objective of this study, which is to explore the availability of the risk disclosure in the annual report on the financial and non-financial reporting section among the 5 chosen FSB in Malaysia. So we have retrieved their annual report for the 3 preceding years, which are 2016, 2017, and 2018. So the analysis focuses more on the narrative part of the annual report, since the analysis show that the majority of the disclosure information is actually qualitative in nature. So the analysis that has been made upon the chosen FSB has shown the differences of the risk management that were disclosed by each FSB. Some FSB may have a similar risk management disclosure, but some other FSB may have additional risk management disclosed due to the nature of their operation that is different from the other FSB. So the study has also found that even under the same type of risk management disclosure, each FSB is exposed to a different kinds of risk, and the management to the risk is different following the FSB Risk Management Committee. However, the analysis activity on the disclosure of the risk management of the chosen FSB is limited to the source and data acquired from the annual report. Moreover, each FSB is based on different types of sectors, so the risk management disclosure differs from each other as the nature of operation and activity are vary for each FSB. So for the future research, it is advisable to explore the risk management disclosure on the FSB that is from the same sector. So this way, the differences between the disclosure of the risk management may generate a useful discovery upon its findings. So that's it from us. Thank you for listening.